Good evening, everyone. Time for another silver update. This is the weekly chart of oil provided by netdania.com. You can click on the link below. I've drawn one trend channel and then one primary downtrend line. You can see the recent activity that we have is a significant spike in the price of oil, roughly about 77 to where we are at about 90 to 91. So we are seeing a rally now in the oil. You can also see that the MACD is beginning to cross over and will also head towards the zero line, which will be, if it crosses and does this, then that will be a significant move historically since we were oversold back in the bottom of 2009. So does this have something to do with the potential war in the Middle East breaking out? Possibly. If Iran is attacked, they'll probably try to shut down the Strait of Hormuz. So that could have a catastrophic impact on the price of oil, and you could see 150 very quickly. If you remember the Gulf Wars, we had percentage spikes like that. And then, of course, once it was clear that the United States was going to win, it came back down. So I wanted to do a little bit of an overlay here to show you spot gold overlaid on top of the oil price to show you how they correlate. So this line up here, this is the spot gold price, and you can see that gold really hasn't rallied. The two have been in a fairly tight range. If we come in a little bit closer, like say to the 8-hour, you can see that the two are fairly well correlated in price, although you can have big discrepancies like this. This was back the September run-up and crash in gold. So they do move in opposite directions too. So now you can see we're kind of breaking out with oil, but gold hasn't done anything. Will oil signal that gold is going to turn up? I don't know. The equivalent gold price for the price of oil right now, we'd be at about $16.50. So we'll keep an eye on the price of oil if it continues to rise, and if gold follows it. That will be interesting. Over to the question of the night. And this is from George Silver again. And it's silver exchange for gold. Dear Brother John, it has always been my intention to change my silver for gold coins when the ratio drops to 20 to 1. I've always regarded gold as the ultimate safety play. For some reason which I cannot put my finger on, I have this idea in my mind that gold is a better long-term store of wealth than silver, with the added bonus of being easily transportable. What are your thoughts? Well, I think always historically that's been the case. You want to convert your silver to gold if you're looking at a situation where you have to exit the country. That's what the Jews did in Nazi Germany. And but will it be different this time? It could be different this time. I could foresee the price of silver actually getting down to 5 to 1, 2 to 1, and even 1 to 1 with gold. And that in that case, then of course silver is just as easily transportable. Well, not quite as easily transportable, because a 1-ounce coin of silver is almost twice as large as a 1-ounce coin of gold. So for them to be equal, you'd have to see a silver price that's twice the price of gold, and that would be quite a stretch if that could happen. Now, the transportability of gold, that's very important, because you could wear a gold belt, I suppose, and you could have as many as 30 1-ounce gold coins on your belt. You could have some in your pocket change and fly right out, and you're talking about 30 or 40 times. Let's say it gets to 2,000. So you're talking about being able to move $60,000 to $80,000 around, and that's not bad. That can get you a new start. So that's always a issue that you want to keep in mind when you're talking about gold, is the possibility of capital flight and getting out of the country. Now, the newest contender on this is Bitcoin. Now, I know a lot of people don't like the Bitcoin. I did want to cover it real quick here because you can see it's broken out and it's rallying towards 10. We're at almost a 2 million volume. Very interesting. It's clear here that the Bitcoin has not broken down. And of course, this is going to be your most secure way of transporting wealth across borders, because really to do so, all you need to do is memorize a password. That's all you have to do. So this is definitely an up-and-comer, and it's going to challenge the powers that be with their controls. Now, I wanted to click on the log scale real quick, and if you put on a log scale, you can see that although it was considered to have crashed, really on the basis of the log scale, we're back up to right here. So that's essentially a 100-fold move. Actually, I'm sorry, we're back up to, yeah, we're right there. So that's essentially a 100-fold move maintained on that. Very interesting to see where that's going to go. Now, on to the post of the night. This is from James Miller of the Ludwig von Mises Institute of Canada. And we're starting to see this break. It's starting to look like it's going to break wide open. The city of Compton is now talking about bankruptcy, and we may start seeing a cascading situation where these municipalities start to declare bankruptcy one after another. But I wanted to read this article because he does such a good job of explaining the fallacy of government sponsored booms and busts through printing paper currencies. During an economic boom, exuberance finds itself lodged in all types of industries. When profits soar, so does the public's disregard for prudence. And as tax revenues rise, politicians can't help but give in to their bread and butter of buying votes. Periods of accelerated economic growth typically come in two different forms. If capital is drawn from a pool of real savings to finance investment in more efficient forms of production, the boost in wages and income will be sustainable as long as consumers remain willing to purchase whatever is being produced in greater amounts. In the case of a credit expansion boom fueled primarily by fractional reserve banking and interest rate manipulation through a central bank, the boom conditions are destined toward bust. Liquidation then becomes necessary as the bust gets underway and malinvestments come to light. For private industry, it means slashing costs, laying off workers, and possible bankruptcy to discharge debt. For government, it typically means shoring up the lost revenue due to unemployment by raising taxes and promising to cut spending by some significant amount. Usually, those promised cuts never come to fruition. Political re-election hinges too much upon filling the pockets of voter blocs. When private enterprise tightens its belt, the state hardly bats an eye, since its revenue is dependent on how much it decides to fleece from taxpayers in any given year. Some levels of government aren't so lucky, however. Without ready access to a printing press or eager creditors, local municipalities in the U.S. are facing tough choices as the Great Recession drags on. Unable to cope with the rising cost of providing public services, many cities are taking drastic action. 3 major cities in California have recently declared bankruptcy, including San Bernardino, which is the second largest city to do so in recent history. The City Council of Detroit, which is facing about $12 billion in pension and benefit obligations, has voted to allow a state advisory board to assist the former manufacturing powerhouse grapple with a fiscal future that is anything but promising. North Las Vegas, Nevada is facing the same kind of hurdle with a gaping $30 million budget deficit. According to Mayor Sharon Buck, quote, "We've balanced our budget, we've paid all our bills, and all of our bonds are paid. Our biggest issue is salaries and compensation and benefits, and they're very unsustainable," end quote. Most recently, the mayor of Scranton, Pennsylvania, cut the wages of city workers to the state's minimum wage of $7.25 an hour. The unions, which represent the city's firefighters, police officers, and other public workers, are taking the issue to court. In carrying out such a drastic pay cut, Mayor Chris Doherty defied a previous court order. The union's attorney called the defiance incredible. The president of the International Association of Firefighters, Local 60, lamented that, quote, "There are kids working at ice cream stands earning more than their fathers, which is ridiculous," end quote. In actuality, there's nothing ridiculous about Mayor Doherty's behavior. The city is out of money to pay its workers. After riding the taxpayer-funded gravy train, the trip has come to an abrupt end. The mayor can't pay money he doesn't have. In his words, quote, "I can't print it in the basement." But to this writer, Doherty didn't go far enough in cutting the pay of city workers. In a just world, public sector workers would be paid the rightful amount equal to their contribution to society, $0 an hour. If production is to entail mutual exchange and careful consideration toward profit and loss accounting, then governments produce nothing without a negative effect on some individuals. The government worker is paid solely through whatever funds are forcefully taken from actual producers of wealth. The kid working in an ice cream stand, whom the president of the firefighters union referred to, is providing a valued service to society. His pay is based off of whatever marginal revenue he brings in. The firefighter, paid by tax dollars, is a functioning leech whose pay is totally separated from any measure of consumer satisfaction. Government workers have little, if any, incentive to serve the public in an efficient or convenient manner. In America, police have no legal obligation to assist you, and if you think the local fire company will be there at your beck and call, just ask Gene Cranick of Tennessee, who watched his house burn down with fire crews standing by as he neglected to pay a $75 fee beforehand. The selfless civil servant simply watched the spectacle of a man's home being destroyed, even as Cranick offered to pay the fee for service right then and there. Compare this to the private, for-profit firefighting that existed in many towns in the 19th century America. As urban historian Mark Thibault describes it in an interview with NPR's Robert Siegel nearly 2 years ago. Siegel: "Now, I read this story, and you can tell me if there's any truth to it, that sometimes competitive fire brigades, in their zeal to be the one to put the fire out, maybe to get an award or be backed by an insurer, might actually have played a little defense against another competing fire company." Professor Thibault: "Yeah, they would race to the fires. This reflected community tensions of the era, as well as a sort of manly pride in being first, not only to get to the scene, but first to put the fire out." No doubt Cranick, who found himself on the wrong end of government's over-bureaucratization, would have jumped for joy at the prospect of multiple fire brigades rushing to save his home. By virtue of its monopoly on coercion, the public sector exists wholeheartedly at the expense of society. Worse are the unions that piggyback off this extortion and kick taxpayers in the gut even harder just to take a few extra dollars out of their wallets. Unions remain empowered through their government-granted privilege of forcing employers to bargain with them, including the various levels of government. But this only scratches the surface to the despicable nature of both private sector and public sector unions. As libertarian economist Walter Block notes, yes, unions are disgusting and repulsive institutions, as the right side of the political spectrum properly emphasizes. They restrict entry into the labor market and either beat up potential competitors, who they characterize as scabs, Where are the politically correct opponents of hate speech when we need them? And or get the government to do this evil deed for them by legislation such as the Wagner Act, which forbids employers from hiring replacement workers on a permanent basis. What the city of Scranton has in common with San Bernardino, Detroit et al. Is that its dire fiscal condition is due to one thing and one thing only: benefits promised to unionized workers. For decades, public sector workers and their professionally dressed cohorts in plunder known as union representatives have operated under the fallacious assumption that government is the gift that never stops giving. But in today's environment of economic stagnation, their dreams of living off of the stolen fruits of labor are thankfully starting to represent reality. Whole countries in the European Union are beginning to crumble under the weight of their bloated government workforces and entitlement programs. American cities are currently facing up to the extravagant benefits promised to public workers. In a matter of years, Illinois and California will likely follow. To quote Pat Buchanan, the salad days of the government employee are coming to an end, as they have already in Greece, Italy, and Spain. To those sick and tired of the tax eater mentality that is destroying the very core of society's productive capacity and moral base, those days can't come soon enough. So, excellent summary. I don't completely agree. I don't think that private unions are terrible. I just don't want unions, government workers, to be unionized. I think that's absurd. And there's absolutely no one representing the taxpayer. But other than that, excellent analysis. Sums it up, especially about how economic growth occurs. It requires capital, which comes from real savings. Now we know, and it needs to finance investment in more efficient forms of production. So we're exactly on the wrong path when we're talking about printing up a bunch of money and having the government spend it, because it's not drawn from a pool of savings, and it's generally not financing investment in more efficient forms of production. So government spent, or money spent by government, pretty much is a lose-lose situation, and it always ends in bankruptcy or currency crisis. And that's what we're going to see again this time. So back to the chart. Oil is rallying. I expect gold and silver to follow if oil continues to rally. And on the longest term chart, you can see that gold still has a little bit of a way to go to correct back to where oil is. But if oil turns up from here, it very well may carry gold and silver up to new highs. And we'll talk to you next time.